everyone, and welcome to the Adjusted for Risk podcast from the very snowy shores of Lake Tahoe. I mentioned this last week that we are officially snowed in. Well, it just doesn't stop as we have another atmospheric river on its way that could drop another 8 feet of snow at higher elevations, and that is on top of 30 feet, at least 30 feet we've already had. Or we could potentially get 8 inches of rain, which is called cause for numerous warnings of floods. We've got a state of emergency going on. So really, at the end of the day, just Mother Nature. You've won. We give up. You can move on to another region of the United States. So we're done. I call uncle. So let's move on to some fun things. And this is going to be a great episode with 2 fantastic guests. It's going to be a good one when I pull out my favorite and my best Wisconsin Badger shirt for this episode. But first, this episode is sponsored by Revisor Wealth Partners. Revisor Wealth Partners provides custom portfolio management solutions for independent financial advisors. So as I mentioned at the opening, I'm very excited to be joined by Landon Jones and Ethan Dunbar of Revisor Partners. Landon is a partner or founder and president of Revisor, while Ethan is the chief investment officer. This is sure to be a very engaging conversation and one that I'm very excited for, as I know I'm going to learn a lot, as both Landon and Ethan have a wealth of knowledge regarding portfolio management and investment management concepts. So with that, I'm going to stop talking and turn it over to the stars of the show, Landon and Ethan, so they can tell a little bit more about themselves. So go ahead, Landon. Let's start with you.
Yeah, absolutely. So I'm married with 2 kids. I've got 2 boys, Luke and Matthew. My wife's name's Monica. My boys are 17 and 15, so they're both in high school. That's very, very challenging, but fun at the same time. I am a financial advisor by trade. So I started out as a financial advisor in 2002 with Prudential, had a little stint with Lincoln, and then I went the independent route shortly after. I still advise that client base about half of my week is spent as a typical financial advisor, and the other half is spent directing traffic and acting as the CEO of Revisor. So that's a nice little overview of my history.
Perfect.
Yeah, and so Ryan, first of all, thanks for having us on. Been looking forward to this. And so my name's Ethan. I live in the Northeast Ohio area, in the Cleveland area. Grew up here. Went to undergrad at University of Richmond, and then I was on the tennis team there. Played a couple years of professional tennis after college, and then came back home. And actually, funny story, I've known Landon since I've probably been 12 years old, 10 years old, something like that, Landon.
I think you were 10 when I first met you, yeah.
I think I was 10.
They used to beat Ryan. Him and his brother used to beat me at tennis when I was in my mid-20s.
I was just going to ask, did you guys meet on the tennis courts of Ohio?
My wife taught Ethan's little brother in Ohio. She was teaching first grade, and we kind of got close with the family and went over to play tennis. And I'm like, I'm going to play tennis with this 10-year-old kid. And I played in college a little bit myself, and he just destroyed me, and it was very humbling.
After that, you still decided to partner with him, even after him beating you, huh?
That's right.
I must have done something right. Yeah, so I've known Landon a long time. I was actually wrapping up my tennis playing career. Unfortunately, I wasn't good enough to make a living at it. I tried it for a couple of years.
Yeah.
And then I was, back at home with my parents, and Landon was hitting with my father. And the rest is kind of history. That was 7 years ago. So I've been with Landon and Revisor now for 7 years, doing the work I'm doing now, and love it. So yep, not married or anything, but got a dog, golden retriever, that follows me around, bring her to the office sometimes, and she works alongside me, right? Sometimes she's sitting here under the desk. She knows it.
That's fantastic. That's a great story. I love these stories. And, I usually at the end, I always ask for a good story. And Ethan, I kind of am looking forward to a good story about tennis. But again, I always say this jokingly. Well, it's serious too. It's a family show. And then maybe we can tell some more of these good stories at a after dark episode
Yes.
of Adjusted for Risk. But
Absolutely.
so with that, let's get on with, we could talk about that story and in tennis for hours, but we should probably move along. So, outsourcing, it has become very popular as advisors. They've had to focus on more value added activities like, building relationships and growing assets under management. Fee compression has made it popular for advisors to outsource their investment management portions of their practices. But, financial advisors, they can be control freaks, right? They always have that concern and fear of giving up control of their investment management portion of their practice. Additionally, some worry that they may lose that potential for creating customized investment portfolios that are suitable for their unique individual clients. So Landon and Ethan, do you feel these fears are a little overdone? And can you maybe describe some of the benefits of outsourcing investment management and what are maybe some of the products and services that still offer the ability for customization?
Yeah, that's definitely a fear, no doubt. But I think it's rightfully so. In other words, when companies like us emerge into the space, we purposefully avoid using the word TAMP as we describe our services. And the reason why is because there's so many advisors that when they hear that word, they think of rigidity, lack of customization, overpriced. I have to pick one of these 7 or 10 models, and that's all I can do. I can't deviate from that very tight rule set. So that's been the history of the industry. So I think it's a valid concern because that's the story of what our industry, the TAMP industry, let's say in general, or the outsourced investment management industry does. So that's actually why we exist. I was looking for an option with customization for my RIA as a financial advisor managing about 100 million in assets here in Northeast Ohio, and I couldn't find anything. I thought I must be going nuts. There's got to be something that is going to work for me and my clients, because each client, they want to add a little flavor of something, like they want exposure to the metaverse, or they want exposure to gold and precious. They want these things, and if we don't think it's a horrible idea as an advisor, and it's something that can make sense for them in their, let's say, speculative bucket, then we want to add those things into their mix. And it wasn't possible to do these things with the outsource options available. So it's definitely a big concern. We built what we built to actually alleviate that concern and to give financial advisors, independent RIAs, exactly what they're looking for, which is do what I want with my clients, manage their accounts in their household, tax management services, all those things, and find somebody that can actually do it at a reasonable cost with all the customization. So
fantastic. And Ethan, more on the investment management side, you've got your hands deep in the investment portion of it. Your thoughts there.
Yeah, I think especially like Landon was mentioning, there's oftentimes cases where a client wants something specific. They want to add gold to their portfolio, or they want to hold this stock because they like it. But oftentimes there's very legitimate outside assets that need to be accounted for in the portfolio. So, for example, someone who owns a bunch of privately held real estate investments of some sort, we can, if you just buy the portfolio or the model portfolio as it's constructed initially, you might be adding to a real estate portfolio that doesn't need to be added to. So from an investment management perspective, if you can look at everything more holistically and take those types of positions into account for whatever reason that they exist, whether it's something outside of the portfolio, whether it's part of the portfolio that's, let's say, appreciated that we can't or don't want to sell because we don't want to create capital gains for the client. Being able to customize around those type of items becomes really important, and it's a lot of what we do is setting up the portfolio so that they account for those type of things for an investor, and design it the way that it's is best for the end investor. So
that's awesome. We've talked a lot about customization, right? It's very important now because, as we know, every investor is unique, right? They have unique goals. So we've got to provide customized products and solutions and investment portfolios. An investment product and strategy that has really grown in popularity recently, in large part due to the growth of outsourcing, while providing a customized solution, is direct indexing. And this is exhibited by large asset managers getting involved in this space, like Vanguard purchased Just Invest a couple of years back. So let's start there. What is direct indexing? It's really popular. Can you give us just a real quick explanation of what is direct indexing?
I'm really glad you asked that, because it confuses the heck out of everyone. And it's just really, really interesting because it's an SMA, right? It's an SMA, but so if we build we know how to do this. We're one of the few firms on the planet that can provide direct indexing services. It's very complex to build, to actually be able to do it at scale with software. And that's the big challenge, by the way, for everybody. You have to be able to take all these trading software systems and billing and everything else and a Bloomberg terminal and actually do it at scale. If scale wasn't required, and if we didn't have fee compression issues and everything else, well, everything would be simple if we could charge our clients 12% and still have and not have scale. So, but what a direct index is just simply, let's use the S&P 500 as an example. It's an SMA, but in that S&P 500 example, we would actually just own the 500 constituents of the S&P, just like you would get inside of an ETF or a mutual fund. And same thing for the Russell 2000, so on and so forth. But what most folks are using are our factor tilted, and not, but in general, we're taking a segment of those securities in the S&P 500 or the Russell 2000 and tilting for a dividend play or a low volatility tilt or whatever the case may be, and whittling down the number of securities, because it's obvious you have to have a really large portfolio without fractional share capability, because some custodians now have that, but not all do. But if you can't buy fractional shares, and an advisor wants the Russell 2000, all the 2000 constituents, the S&P 500, you have to buy one share of all those securities. There's going to be a lot of dollars needed in those accounts. So we're normally whittling down and using the S&P or the Russell 2000 as the starting universe, doing that factor tilt. We use our Bloomberg terminal to do so, and then having a sleeve of securities that's maybe 40 or 50 stocks to make up each sleeve in the asset allocation. Hopefully that was was helpful.
Fantastic. So Ethan, that was a perfect explanation of it. Why would somebody use direct indexing? Like you said, it's very similar to SMAs, or, maybe just use a more niche ETF, for example. What would be the benefit of direct indexing over, maybe a different product that's very popular?
Yeah, there are numerous examples. One, just in general, I'm always a proponent of actually owning the investments, getting as close as you possibly can to the investments. So I like to use like a farming analogy, right? If you're gonna, if you're on a farm, I don't know if you know this or not, but if you have a chicken coop in your backyard and you go out there and get that egg out of the chicken coop, you don't actually need to refrigerate that egg. You can put that on your counter. You just kind of dust it off, and it's got a layer of film on it that protects it from the outside world, from going rotten and all of that stuff. Industrial farming, for example, has made all of our eggs are white. They're scrubbed clean because they're coming from this. There's a bunch of layers in between where that egg was laid, and when we actually crack it open and eat it. But from my perspective, I think that direct indexing, separately managed accounts, just eliminate the number of layers between when we picked that egg up out of the chicken coop and then we ate it. It's the same thing with the investments. The closer you get to them, the purer that exposure is, which I think is really good. The other thing is some of the other big advantages are from a tax perspective for your taxable accounts. When you have a security, a portfolio of securities that's 40, 50, 60 companies, if you bought an ETF that owned, or a mutual fund that owned those exact same 40, 50, 60 companies, well, for the year, let's say we're up 10%. Well, that position is up 10%, and that's great. We might have 5%, 10% of those companies that are actually at losses, where we can harvest those losses, find a suitable backup that still has the correlation alongside the portfolio that we want, have this essentially the same return, but have a tax loss carry forward. And that's another big advantage in the direct indexing world, is since you're closer to the actual investment, you have these opportunities to take advantage of losses within the portfolio. So that's a big one for me, that I think people can take advantage of, especially in their taxable accounts.
Mm-hmm. Fantastic.
One last quick thing there is the real estate example. Let's say we're using, when we build I like to call them custom / direct indexes, because the tax piece is huge, that Ethan just said. Let's say we've got a client that owns a lot of real estate. Keep using that example. They don't want any additional exposure to real estate. We can just remove the real estate sector. Mm-hmm. Try to get Vanguard or BlackRock or whomever in their ETFs to remove a specific sector. We're not going to get that accomplished, right? Yep. So in this world, since it's a separately managed account, we just customize the index and remove a specific sector, or even remove a specific position. If somebody works at Charles Schwab and has a huge amount of their risk exposure in Charles Schwab stock, then we can build their indexes in any spot where Schwab would show up. We just eliminate that security. They already have exposure there. So that's a huge piece, in my opinion, as well, as being able to eliminate sectors or whatever needs to be done to customize.
Fantastic. Going into preparing for this podcast, I did not think we were going to talk about eggs and farming, but growing up in Wisconsin, living, having a family-run farm, I love it. That's great. Maybe Ethan can come on. We could talk more farming someday.
Talk some cheese. We need to talk some cheese.
Yes,
man.
cheese and beer.
Yeah.
Maybe next time you guys are on, we'll have some beer and cheese.
Love it.
For the episode. Landon, you talked about SMAs and direct indexing. Very, they're similar. Right. But with SMAs, it's always, you have that thought that it's got to be ultra high net worth individuals or institutions that use SMAs. Is that similar with direct indexing? Who is direct indexing really beneficial for?
So, wonderful question. We're using this with my retail client base. Okay. So Ethan, and we've got a bunch of other awesome, Ethan's brother works for us. We got Nick Cargill and a bunch of really, really smart people that are involved in our trading activities. They're trading all of my local Northeast Ohio clients. We have $250,000 households that are assigned to these portfolios. So with fractional shares emerging as well, which there's some people that say, I don't like fractional shares because who's voting the proxies and all this stuff. But at the end of the day, that's technology advancement, right? So as that emerges 5 years from now, everybody everywhere is going to be able to buy fractional shares of securities. So when that occurs, in the event that somebody likes the idea, this story doesn't resonate with everybody. There's certain people that just say, hey, I love my ETFs, leave me alone. That's all I want to use. That's fine. But at the end of the day, you can have a household even without fractional share capability. So right now at Schwab, that's where most of my retail clients' assets are custodied. Schwab has fractional share capability called Schwab Slices if you open an account on the retail side, but not if you go through the institutional side and are working with an RIA. So we've got $250,000 households that are assigned to these individual stock custom index models. And when fractional shares become capable at Schwab and the other custodians, at that point, this concept is available for anybody, even with a $5,000 household value. So it's pretty awesome. Things are changing fast.
Yeah, and like you said, a lot of it is due to technology, right?
It is.
So, I personally think direct indexing, it's a fantastic solution to offer customization and, potentially for outsourcing. What's the future growth look like in this space? Are we looking at potentially more asset managers getting into it? Are you seeing more clients asking about direct indexing? Is it something that, is going to continue to grow?
Ethan might have some additional data on this, but here's what it's everywhere. Everybody's getting emailed. All advisors are getting hit with it, from all directions. So it appears, and you have all the custodians like Schwab, for example, has rolled out their model where you can now get a direct index directly from Schwab. I think it's going to be huge. And if you look at some of the projections from like Cerulli and Associates and whatnot, looking at the year-over-year growth, I think we're going to peck away. And as a decade from now, maybe half of the money that's in ETF and mutual funds, if fractional shares, if everything continues as it is now, I could easily see half of the like 23 trillion or whatever it is in mutual funds in 40 Act funds could very easily a decade from now be transitioned into direct indexes. But hard to say for sure. But that would, if you ask me, that'd be my guess. In a decade, that's the type of market share we'd be looking at.
Ethan, do you have anything more to add there?
Yeah, the only thing I would add to that is, I work with like Landon's clients indirectly, and then we have a bunch of advisors across the country that we work with. And you hear these initial sometimes apprehensions from the advisor or from the clients. I just don't want to see that many stocks on my statement. My statement's, twice as thick as it was before. But at the end of the day, when first of all, we have reporting tools that make it very easy to show what we actually own, and it actually increases the transparency versus decreases it, so people really can truly understand what they're owning. And at the end of the day, after the experience that the clients have had and the advisors have had actually owning the individual stocks, they're all pleased with it. They all love it, and they don't want to go back to the old world typically, because you have that increased transparency and you get to see what you own, and they get over the fact that they have 200 positions instead of 10. I never hear about that again after the first the first statement comes out, and then I never hear about it again. They're like, oh, I get it.
Well, most people, they just look at that bottom line. Am I making money or am I losing money? Right.
Right.
Yes.
So one of the last questions here, and we've talked a lot about SMAs and direct indexing. How are they different? And are the situations where one might be a better investment option than the other? Are there any option or, thoughts there between the two?
I think, Ryan, this is like everything else. So it's personal choice, where the investment advisor or the financial advisor, it has their philosophy and their beliefs, and the client base normally does what the client trusts the advisor. And so some advisors like active management, some like passive, some like alt beta, factor tilting, so on and so forth. So if an advisor doesn't like the idea of the client having transparency and seeing all the actual securities that they own, then they're not going to like this to begin with, right? But if you really peel away all the layers of the onion, you get a better result. And that's what's interesting to me when we talk to advisors. I go, you guys realize we're in a field where this stuff is measurable, right? We're talking about these things, but we have the capability to do this direct indexing thing for you at a cost that's equivalent to the underlying ETF cost. We can bring transparency to your client base, improve the net after-tax result. And if that resonates with the advisor, then it's a way to improve the results of the portfolio. Because when you piece all the layers together, the tax management piece, the lowering of risk and everything else, like you said earlier, at the end of the day, the client and the advisor are looking for the best result. So what's very interesting for us is we're managing these portfolios for RIAs across the country. So they pipe their data into Adapar, which is our performance reporting system, net of their fee, right? So net of fees at all layers. So we get the luxury of seeing how are all these legacy portfolios, because these advisors we work with, they don't automatically transition every client account into our portfolio structure day one. So we get to see the real live results. And I would just say it looks really good for us. The actual results look really good. And that's something that advisors can ask for and take a look at. So at the end of the day, it's results, transparency, low cost, so on and so forth, with a really, really high value for the end investor.
Awesome, Landon. That's perfect. So in closing, Ethan, I'm going to turn this to you. You know, ATP, Tour, Tennis Pro, any good entertaining stories that you can share? And then Landon, maybe you can start some story, share a story about you know, on the tennis courts playing against Ethan.
Oh, you know what? Landon mentioned earlier that my brother works for us, so he's kind of in charge of our trading operations. So I'm going to throw him under the bus a little bit here. I'll go back to my college tennis playing days. Actually, and just to preface all this, my brother Jacob and I are best friends. We both went to the University of Richmond. Purposely, I took an extra year. I redshirted a year, and he graduated early, so we could spend more time together at school. And I'll tell you, we were on this spring break trip. And
remember, family show, Ethan. Whenever we start the statement by spring break, I got to go family show.
Family show. I promise it's a family story. It's funny, but we were warming up for this match, and we played doubles together in college, and I accidentally hit him in the back of the head with a tennis ball. So flip around, it's his turn. He's serving at me, and he serves the next ball as hard as he can into my back. And I'll tell you what, that was one of the only times we actually got in a fight in college. But I was apprehensive when he started working with us the first time. He's been working with us now for like 2 years almost. And I'm waiting. It's coming soon, because that was about 2 years into college that he, you know, wound up and hit me with the serve. And mind you, he can serve like 130, 140 miles an hour. It left quite the welt. So I'm just waiting, Jacob. We're within a couple months of him coming to the office and starting serving at me.
I was just going to say, Landon, you might want to put a rule in the office that no tennis rackets or tennis balls in the office.
We keep those out of the office so that Jacob can't come get me.
Landon, any good fun story or anything you've seen recently that's kind of a surprise or interesting?
Man, so many. Oh man, I don't know. I was thinking about the time you had my brain going in the tennis direction, and when I was talking earlier about Ethan and his brother, when I went over to their house for the first time, the funny part of the story is it's not a joke. These 10 and 6-year-old kids actually beat me. Now I wasn't playing tennis for the first time. They're playing at like this really, really high level, and I watched these little kids walking on the court. And I had played in college, but not like them. I played at a junior college, you know. Perfect. But that was pretty funny to me to have these little kids come out and just destroy me on the tennis court. It was good stuff.
That's awesome. You guys are now business partners. So great. That was a fantastic conversation. Thank you again, Landon Jones and Ethan Dunbar of Revisor Partners. Real quickly, we're running out of time here. Where can viewers get more information on Revisor Partners?
We're all over social, man. YouTube, Twitter handle @Revisor Partners. It's very, very easy to find us. Revisorpartners.com website. All that's getting revamped and rebranded. We're pretty happy about that and proud of that coming forward. But yeah, easy to find us.
Awesome. Thanks, guys. I really appreciate it. Thank you all for listening to this episode of Adjusted for Risk podcast. You can watch this episode on our Adjusted for Risk YouTube channel, as well as listening to Spotify or iHeartRadio, anywhere else you get your podcast. Thank you again, Ethan and Landon. Fantastic conversation, and hope to talk to you soon.
Thanks, Ryan.
Thanks for having us.
Bye-bye.
And go Badgers.
Go Badgers.